Robert, given what we know right now about the markets, the context that we're seeing, record highs, interest rates falling, inflation concerns still part of the mix, do you feel as though you are getting more comfortable with the markets despite many of those warning signs that we're seeing?
Yeah, it's a great question, and good morning, Dom. I think there are a lot of warning signs. Certainly inflation is the biggest of them. What we've found really interesting is as inflation readings have moved higher from 2% to about 5% in recent months, the bond market has actually steadied. And as you noted, yields have come down. That's sometimes a bit perplexing. We wouldn't expect that reaction naturally. But I think there's a few things the bond market is looking to that encourage us with regard to the fact that inflation might be peaking here. So ratings might stay a little bit elevated, but we think they're going to cool down. You see some of the front end prices starting to slow down a bit, things like lumber. And then lastly, I would say we found that you don't want to underestimate the supply side of this economy. It's shown itself able to really dramatically and dynamically expand supply on short notice and solve a lot of problems. And we think that's the process that's going on now.
I'm really glad you brought that up because it's been something I've been paying attention to as well. We've been talking about this idea that supply chain issues could be kind of pushing prices higher, and it could be even a medium to longer term phenomenon. I don't know if the pandemic is the perfect example because, yes, we rallied as a country to produce things like hand sanitizer and wipes and everything else and PPE. But it seems to me as though when there's a will, there's a way, Robert, right? When people focus on these things, the supply chain issues will get cleared up. How long do you think it takes?
I think that's right. And I see things the same way. I think it's going to be a little bit different for each type of pricing. You know, we've seen lumber prices come down pretty dramatically in the last few weeks. Other areas, it may take a little bit more time. We heard some of the automakers talking about starting to solve problems with the chip shortages. That may also take a little bit of time. But we think it's going to get the job done. So our expectation is that CPI readings remain elevated, but perhaps the prior reading or the next one may be the peak. And you'll start to see that second derivative come down a bit. I think folks will get a bit more comfort there. And as we work through some of the hotter summer months into the fall and winter, we think just as the temperatures cool, some of the prices will as well.
All right. So if those temperatures are cooling, the prices are cooling down, are there specific parts of the market that are poised to do better in that kind of an environment?
I think so. I think the easiest thing here is to sort of get off the inflation roller coaster and really follow earnings higher. The real hidden gem in this market has been the fact that earnings have been spectacular. We're unsurprised by that given the COVID cycle. But even when you rewind the clock back to 2019, earnings are up, 10 to 15% above where they were in 2019, the last normal year that we had. And expectations are that that will continue into 2022 as well. So I think there are a lot of areas to like, both on the organic growth side and the cyclical side. So some of the technology space, small caps, some of the industrials area, all of those are places where we think you can find good opportunity to follow the earnings.
Shepard Smith here. Thanks for watching CNBC on YouTube.